Hello friends, in the previous videos we have already seen that Ind AS becomes applicable to a company when its net worth is equal to or more than 250 crores. Okay, now what we are going to see is how to compute this net worth for the purpose of identifying the applicability of Ind AS. Okay, what all things you have to consider when you compute the net worth for the purpose of Ind AS application. Now in this, the first point is based on what date you need to determine the net worth. Is it at the beginning of the financial year or as at the end of the financial year? What is the base date? Now for this purpose, Ind AS says that the net worth have to be computed as per the audited financial statements as on the end of the previous financial year. Okay, so you will have to see the previous financial year if you you have to take the audited financials for the previous financial year and see what is the net worth in that audited financial statements. Now, say for example, I will just give you an illustration over here. Suppose you are evaluating about the applicability of Ind AS for the financial year 24-25. Financial year 24-25. Okay, so if you are evaluating the applicability for 24-25, what you have to see is the audited financial statements as at the end of the previous financial year. Which is the previous financial year here? The previous financial year will be financial year 23-24. So take the audited financial statements as at 31/3/2024 and compute the net worth based on this audited financial statements. So friends, I hope that is clear to you. Okay, if you are evaluating the applicability of Ind AS for a particular financial year, you have to take the audited financial statements of the previous financial year and see what is the net worth in that audited financial statements. Okay, so if it is for 24-25, see the audited financial statements for 23-24. And if you are evaluating for, let's say, 25-26, what do you have to do? You have to see the audited financial statements of financial year 24-25. Okay, so that is the first point. Now, why they are always linking it to the previous financial year? Because if you want to apply Ind AS for a particular financial year, you can't just do it on the 31st March of that particular year. No, that's not possible, because Ind AS is an accounting method. It's an accounting regime. Okay, so if you have decided to apply Ind AS, you have to apply that right from the beginning of that financial year. So if you need to apply it for financial year 24-25, you have to apply it right from 1/4/2024 onwards. Okay, and how you will be able to apply Ind AS right from 1st April 2024? Only if you know that you are eligible for computer or you are required to comply Ind AS right from that date. Now for this purpose, you can only rely on the previous financial year statement, not that particular year's financial statements. That is the reason why they are asking you to see the audited financial statements as at the end of the previous financial year. I hope that is clear to you. So that is the first point. Now, having got the audited financial statements for the previous year, how to compute the net worth? Okay, what is the method in which you have to compute the net worth? For that, you have a table over here. Okay, the components that you have to consider while computing the net worth. The first component is the equity share capital. Of course, every audited financial statements will have the equity share capital. See, here you have to consider what capital? Equity share capital only. I'm not talking anything about the preference share capital here. So consider only the equity share capital here. Okay, that is point number one. Now, what is the next point or next component? Next component is preference share capital. Now, when you see preference share capital, there is a condition attached to it. You can take preference share capital only if it is in the nature of equity. Preference share capital in the nature of equity. What does it mean? What does it mean? See, when you come to let's say you are going to learn about financial instruments, Ind AS 107 and 109. In this, we will be learning about financial instruments. And while you learn about financial instruments, we will come to know that preference share capital need not be share capital always. Okay, you know that preference share capital is something which gives a preference to the shareholders in the payment of the dividend as well as in the payment of the principal. But if you see, sometimes this preference share capital has the nature of a debt component, or it can also have the nature of an equity component. Either it can act as a debt or it can act as a equity. Sometimes it will have a hybrid nature also, debt plus equity also. Now when we learn about Ind AS 107 and 109, there we will deal it in detail. Okay, first we will have to bifurcate this preference share capital into debt or equity or debt plus equity. Debt plus equity is what is known as hybrid instruments. Hybrid. So we'll have to see whether it is a purely a debt instrument or purely an equity instrument or a hybrid instrument where you will have both debt plus equity components. Okay. After deciding that, you will account this preference share capital either as an equity or as a debt. Now, when you compute the net worth, you have to consider preference share capital only if it is in the nature of equity. For the time being, keep that in mind. You will consider preference share capital only if that preference share capital has the color of an equity as per Ind AS 107 and Ind AS 109. Okay, otherwise don't consider preference share capital. So that is the second component. Now what is the third component? The third component is the securities premium. Securities premium including ESOP reserves. Okay, now ESOP reserves is also something which we will learn when you come to the basic standards on ESOP. Okay, now securities premium, if it is there in your financial statement, then that also have to be considered here. Okay, now next, capital reserves. Okay, capital reserves is a special item. See, these are the things which you have to be very careful from your exam perspective, because they will give you some adjustments over here. So unless you are clear about its conditions, you will not be able to compute the net worth. Okay, now capital reserves are reserves which are created for specific purposes. Okay, now they say that capital reserves can be considered only if it is in the nature of promoter's contribution, not otherwise. Okay, capital reserves you can take, but only if it is in the nature of promoter's contribution. Like for example, you are having a factory, you are setting up a factory. Yours is a manufacturing entity and you are setting up a factory. Now sometimes when you set up factories in backward areas, you know, the government might give you some grants. Okay, government might give you some grants, and this grant can be in the form of equity contribution. The government, even though they call it as a grant, sometimes they say that this grant is our participation in your equity. We don't want any voting rights or any equity share capital assets, but it is towards the investment you have made. Okay, so those kinds of grants which are specifically given towards the investment in any factory or in any project by the government or by a third party are classified as in the grants in the nature of promoter's contribution. We will come to know about this when we deal the specific standard on grants, accounting for the government grants. Okay, so the capital reserves, only if it is in the nature of promoter's contribution you have to consider. All other capital reserves have to be excluded, no other way. Okay, so that is the the fourth one. And the last one, free reserves. Free reserves as per statement of profit or loss. SOPL means statement of profit or loss. Statement of profit or loss. Okay, now this free reserves have to be taken after adjusting for any losses. So if you have any losses not set off, that also needs to be adjusted, and the net free reserves have to be included. Okay, so I will just repeat it. For the purpose of computing the net worth, you have to see the audited financial statements for the previous year. That is point number 1. And once you get the audited financial statements for the previous year, you have to compute the net worth by including the equity share capital. 100% you have to consider it. Then preference share capital you can take only if it is in the nature of promoter's contribution, not otherwise. So the preference share capital only if it is in the nature of equity, not promoter's contribution, only if it is in the nature of equity. And the next one, securities premium have to be considered including the reserves which has been created as per ESOP accounting. And the capital reserves can be considered only if it is in the nature of promoter's contribution. All other capital reserves have to be excluded, or only those capital reserves which is in the nature of promoter's contribution can be considered over here. And the last one, free reserves as per the statement of profit or loss, and this can be taken only after setting off any unadjusted losses. If there is any unadjusted losses or unset of losses, that also have to be adjusted against the free reserves, and only the balance can be considered. And the total will be the net worth. And they say that if this net worth as per the last audited financial or the audited financial statements of the previous financial year is equal to net worth equal to or greater than 250 CR in rupees, then Ind AS is applicable. Ind AS applicable. So Ind AS will be applied only if the net worth is above 250 crores, and how to compute the net worth also we have seen. Friends, I hope this is clear. From your exam perspective also, this is very important. Okay, this calculation is very important because they will give you some adjustments on this. You should be absolutely clear how to compute the net worth for this purpose. Thank you.